Hey, how are you all doing? Gonna try and bang out another video actually. Quite close to the release of the last one. I just need to try and be a bit more productive with my time off, so that's what I'm gonna try and do here. See if we can go through a few companies and see if we can find anything worth investing in. As you can see, I've had a lot of I'd say conversation with AI about value screening, and like specifically some of the people that I look up to, like Monish Pabrai, Michael Burry, Lee Lu, Joel Greenblatt, like how they would screen. Gone, I think, for some sort of blend between Michael Burry, Monish Pabrai. Lee Lu and Joel Greenblatt are a bit more return on capital oriented. Maybe not so much Joel Greenblatt in his early days, maybe not Lee Lu in his early days as well, but it seems to be that way now. By trying to buy very good companies for a reasonable price. Warren Buffett, that, isn't it? Berkshire, which is ironic because we're going to get onto that actually. Berkshire, that is. So yeah, trying to look for, I don't know, what would you call it? Would you call it deep value plays? I suppose they are deep value plays, really. So you can see my criteria up here. Anything over 20 million market cap. Now, that is very low, and I don't know that I'm actually comfortable with it being that low. But when you look at a lot of the value investor write-ups that Michael Burry put in his early days, I got a funny feeling like the average market cap was only like 120 million or something like that, and there were some really low market caps in there. I think there was like a 25 million in there. So there's obviously stuff in that area that's massively overlooked, but it could stay overlooked because funds can't buy into it when it's that small. It's not going to make a material impact on them. They'd end up having to buy the entire company effectively. And obviously that comes with a lot more regulatory issues when you're going down that route. But I've gone for that anyway. I said mainly because of the influence of what Michael Burry, the size of the companies that Michael Burry was investing in. 20 million is very, very small, and at the moment, that's what I'm screening at, but I don't know that I'm overly comfortable with something that small yet, but we will see. Time will tell. Obviously, performance, dog shit is what we're looking for. Done a price to book of 0 to 1.5. Really, I'm looking for a tangible book to be positive, or if it's not positive, then it to be backed up by a lot of decent cash flows. I don't know what sectors I dropped out of this actually. Probably biotech, health services, health technology. Yeah, not really interested in that sort of thing. EV to EBITDA under 7. TTM. I've price to free cash flow or EV to EBITDA. I've got price to free cash flow up here, but I've not used it, but I was very torn between which one to use. I know that Michael Burry is very big on EV to EBITDA. Roaring Kitty, Keith Gill, said that it's one of his favourite ones to use as well, so it's probably why I've gone towards it. Like, price to free cash flow doesn't take into account debt like enterprise value does, but an EV to EBITDA doesn't take into account maintenance capex, so it's like, or any capex, so it's like 6 of one, half a dozen of the other. I've gone for EV to EBITDA purely because it takes into account the debt, and I think if you're looking at the performance of companies that this screener is, you're probably better off trying to take into account the debt. Like I said, I got debt to equity there as well, 0.5 to 1. Honestly, can't remember where I got that from, but that's what we're looking at. That's what brought up PSHG, Performance Shipping, which was on the last video that I put up, which I was very excited about, and then unfortunately realized that the potential dilution was crazy, and as the price was above like some of the options prices already, the chance of dilution was pretty high. So I did put a alert on it in case it comes back down. It's been trading in this channel really since a year and a half, 2 years. over 2 years. So we'll see. We'll see if it comes back down. I'll probably be interested in it at a lower price, but with the potential dilution, I'm not going to be interested in it at that price. Not really been looking at these. Diamond Corp. The one that caught my eye was SiriusXM Holdings. Now, obviously, it's a company, most people will have heard of it. I'm in the UK and I've heard of it, so that's where I'm at. I've dragged it into the spreadsheet here, just to have a quick look at it. I've got it up on ChatGPT. I've got the balance sheet and all that up here. So literally just going to try and figure out what's going on. And I mentioned Berkshire earlier. Berkshire have been buying into SiriusXM quite hard in the last couple of years. Like, I mean, it's not a big, go on Well Wisdom here and see, it's not a big position for Berkshire in terms of their portfolio. They own the majority, 37% of the company. Berkshire Hathaway, it's only 1% of their portfolio, but then is 1% for Berkshire with the amount of money they got a reasonable conviction? Possibly. It's interesting that they're still increasing their bets in it. You know, when was that? And what, towards the end of last year, 100 million, and they bought in again. Share change has gone up again, according to Well Wisdom. Only, I said, only 1% of their portfolio, but Berkshire's huge, absolutely huge. Everyone knows that. But 37% ownership, and it's like, well, maybe something there then, you know. So where I was at is I was looking at, they got a lot of debt. You know, 8.6 billion due in debt now. It's whether or not that debt's going to get in the way, and we'll get onto that in a minute. I generally start off on what like a liquidation tangible value would be. Obviously, you've got awful lot of goodwill here, which I don't normally like. I know Warren Buffett spoke about economic goodwill, and he doesn't mind that sort of thing, but I mean, I'm not Warren Buffett, not even remotely close, and I'm very early on in my journey, so currently I don't tend to like goodwill, but 8 billion in debt. Where is it there? Sorry, down there somewhere. There you go, 8.6 billion in debt. If you look at the debt schedule, so is this the one I was looking at? Or is it this one here? Might even be down here, actually. Long-term debt schedule. That's the same thing. Looking for here. Maturity date 2026. Sorry, I was looking at it on the I'll go back to it. It's easier to find it on that, but you'll see what I'm talking about in a minute. I'm just waffling a minute here. There we go. On this one here, notes table, details. Where is it? Down here. Pardon me. Sometimes it's a bit easier to read when it's like this, than actually inside the 10K or the 10Q or whatever. I generally will go to this, but if I want more information, the notes are easier to read inside the proper 10Qs, I found. But pardon me. Billion 2026, 1.5 billion in 2027, 2 billion, you know. These are not small sums of money, but shorter term, I'm not overly worried about the debt when you consider the average simple free cash flow over the last few years. Yes, it's been shrinking, but they're still, pardon me, they're still around about $1 billion at a time. So if you've got $1 billion in debt, yeah, I mean, if you've got $1 billion in debt coming due, it's difficult because I don't really know. I'm not overly bothered about it just because simple free cash flows would cover the debt. The only other thing as well is that you've now got Berkshire's backing as well. They own 37% of the company. Is the debt really going to be a huge issue if Berkshire continue to see some sort of value in this company? I'm not saying that they'll help them out, but there's potential that they're going to help them out, and especially when it comes to refinancing, you're going to find refinancing a lot easier when you've got the might of Berkshire Hathaway behind you. So I'm not overly concerned about the debt. Yes, it's high, but it's probably manageable, at least in the short term. There will be some refinancing, I would imagine. I would imagine there will be some refinancing, but so when you consider a simple free cash flow down here is around about $1 billion a year, I don't think any sort of refinancing is going to be a problem. Biggest problem where I mean, not questioning Berkshire at all, okay, but my position in my journey, I'm not really seeing the value that they are. They're piling heavy into it. Majority owner of the company, but pardon me, I can't stop coughing. It's like trading for 15 times EV. It doesn't seem overly cheap to me. It would take 15 years on simple free cash flow to buy out the company and all its debt. That's like, is that a great investment? I know Berkshire's timeline is much different. I just don't think you'd see someone like Monish Pabrai, who regularly talks about he wants to be paid back in like 3 years, investing in something that's, multiple 15s. I don't really know. I mean, the dividend yield is good. Don't get me wrong. Okay, the dividend yield, that could be a portion of it as well. There's about 5% dividend yield, I believe, at the moment. If we go on here, 27 cents, 27 cents, 27 cents, 27 cents. So about $1, and so you're looking at just under a 5% dividend yield, which is pretty good. And if you're parking a lot of money in it, like Berkshire are, that's a reasonable amount of money out of it. The long-term trend, though, is awful, truly awful. Generally, I look at the weekly, but I mean, I don't know. Like, look at that historical highs. Past performance not indicative, obviously, but that's a triple there, and there's been a lot of significant action around here previously. We seem to have found a floor for a little while. JP Morgan's raised the price target to 24. Neutral to neutral from underweight. When was that underweight? It's gone up like $1. Yeah. I said there's something there, right? And obviously the licenses are worth money as well. I'm just trying to wrap my head around, maybe if someone watches, they could comment and tell me. I'm trying to wrap my head around the Berkshire thesis on this, I said I'm reasonably happy with the debt. The debt's high, but I'm reasonably happy with the ability to service it, and at the very least, refinance it. Goodwill's massive. I don't like goodwill that high. Wrong one. That's why. Net income, 800 million. Is there anything in here that's impairment, restructuring costs, depreciation, share-based expense? There's nothing in here that's untoward, is there? There's nothing that's like sticking out to say that there's anything bad. Even in the capex portion of it, it doesn't seem like there's any real potential problems afoot, despite the level of the debt. It all seems manageable, and like I said, you got the might of Berkshire behind you. I don't know that I'd be willing to pay more than what it currently is. I mean, what was the highest Berkshire bought? 42 million at 27, but more than that, 100 million at 27. So they thought it was cheap at 27 up here. I mean, don't get me wrong, 30% is really good. If it was to get back to there. I don't know, generally, because of my inexperience, I'm trying to find stuff that's going to return more than 30%. I want it to be so undervalued that like Money for Price said, it smacks you over the head. Like, you potentially can't be wrong. Now, I know they're very, very rare to find, but you can find 2 or 3 of them a year. That's you done, you know? Yeah, I've been buying back stock though. Look, the outstanding shares has dropped. Revenues, yes, they've dropped in recent years, but they're still up on, COVID era. Gross margins dropping off slightly. Simple free cash flow margin's always been very good. Exceptional along this period. Right, green all the way back. So you're talking over 10 years. Simple free cash flow margin's been very good. It's taken a knock in recent years. SG&A margin come down massively. So not massively, but a few percent. So the costs are coming under control. Don't really know, to be honest. Don't really know what to think about this one. I would like to form an opinion on it just because of the amount of the Berkshires come into it, but balance sheet. Intangible assets. Would FCC license class as an intangible asset? What is it classed as on my... Oh, look. Intangible assets of only 1 billion. 12 billion in goodwill. So on the data that I've got, it's classed as a actual asset, is it, by the look of it? 26 billion in non-current assets. It would be under there then, I'd imagine. 9 billion other non-current assets. FCC licenses. Yeah, that's where it's going to be, other non-current assets. I was trying to figure out if you could put a price on the licenses, because obviously they're worth something, but they're also, like I said here, regulatory grants are not an owned asset that you can particularly sell. It has to be worth to them. What that is beyond me, though. So I suppose straight away, for my level of experience, it would be put in the too hard pile. Warren Buffett has a too hard pile. Monish Fabry has a too hard pile. I was just trying to see what I could see that the Berkshire's so interested in. There's another one as well, I think, that's got a significant portion of their portfolio in it. 10%, 8%, 8%, 7%. So there's some significant conviction in this. Don't know who these people are. Investment strategy, long-term purchases, undervalued. Holding them in a client's account for a duration of a year or longer. So, I mean, that's still quite short term. Next one. Who's the next one? Dope. value-oriented investment approach focusing on long only equity securities. I said, do I see anything in this though? Like, I tend to do value multiples against the enterprise value. I suppose the only thing is what would happen. You know, you've got leverage on your side if you do pay off some of if the enterprise value stays around about where it is, and you've got leverage on your side, and you pay off over the next couple of years, what, what was it going to be? Let's have a look. Down here something. So what's that? When's this due? $1 billion, $1.5 billion. Half your debt is coming due within the next 3 years. Is that right? Yeah, $8 billion. Around half your debt's coming due within the next 3 years. So if you could get rid of around about not that I think they're going to have to refinance some of it, but I don't think they're going to struggle refinancing it. You'd have quite a bit of leverage on your side, getting rid of that debt. Yeah, don't really know where I stand with it, to be honest. I just don't like the high level of debt. Probably just worth moving on, but EBIT, what's the EBIT multiples? 5 on market cap, 11 on EV. Off of earnings, what could they realistically pay down? Earnings, maybe 2.5 of the, what's it, 4 billion due? 3 billion maybe? Like 3 billion's going to be a push in it. That's basically all of your simple free cash flow. 2.5's probably too much as well, but tangible book is going the right way though. Like it was, what was it last year? $33, $34. Now it's only 6.7. So what did that compose of last time? Is that from write downs or? Yeah, well, I don't know. It must have been a huge write down. Is there anything about that? Anything about goodwill write downs? Raw goodwill narrative. This is where you move to the proper 10K. I find it a lot easier. Oh, goodwill. Goodwill is 40 bloody. Impairment charges are 3 billion. Jesus, it comes up a lot. Is that right then? Is my data right? Because this time last year it was 12.39 billion. Now it's 12.39 billion, and yet my data 12.39 was higher. It's the intangible assets that have been hammered. It is. I wasn't looking. Sorry, that's on me. The intangible assets have been hammered, not the goodwill. The goodwill has come down, but the intangible assets have been hammered. They've had some huge impairment charges. Let's see what we can come up with. See what we can come up with there. Control F. Impact. 3 billion. It was goodwill. Intangible assets, here we go. 2024. Annual impairment assessment. Okay. Nothing really in there that I can see. It's whether or not the data's right, I suppose. Intangible assets. Let's compare that to what Yahoo's saying. I feel like there's a lot of fucking waffling in this video, I've got to be honest. This is what it is, not my finest work. Expand. What am I fucking looking for? Intangibles. No, see, they still got intangible assets at 10 billion. Something's not right in my data then, is it? 10 billion down to 1 billion. There's 0 missing there, maybe. 10,065. 10,189. There's possibly a 0 missing in the data. That doesn't make sense for what you're reading, does it? Right. Revenues to, I mean, $25 of revenue per share. It's trading at 20. Yeah, dividends around about $1, but that's actually quite high compared to what it was supposedly previously. Interest coverage of 2.422. Historically, it was above 3. 2.4 is reasonable. That's what I said. I don't believe that the debt's too much of a problem. Either my head in the mood or it's above me, but I can't see what Berkshire's seeing in it. Other than the fact, like I said, the equity would go up if the debt's paid down. Maybe there's a bit of leverage at play, or it could just be the fact that dividend's 5% currently, although it wasn't last year. They were buying in at 27. Let's see what Berkshire have been buying SIRI. Quite really. What is it that they are seeing? See if ChatGPT can tell me. Actually, Steve Eisman posted a video on Friday. Actually found it quite interesting that he is almost saying that he's worried about the future of ChatGPT, and like OpenAI could disappear because Google's AI budget more than doubled, went from like 90 million to 180 billion, 90 billion to 180 billion. And obviously Google's got huge amounts of income, huge company that can afford that level of capex for their AIs, but ChatGPT's never turned a profit. It's done on all venture capitalism, and should those venture capitalists now think, hang on a minute, we can't compete with having to double the cost of the capex, then he's saying that OpenAI could just disappear, which I found quite interesting. So we may end up having to move over to Grok, or depends how good they make Google Gemini, I suppose. Valuation. SiriusXM has been trading at low earnings multiples relative to both its earnings and free cash flow, making the stock look cheap on a valuation base. The current prices the company offers, 5%, well above large stocks, especially attractive for value investors. Yeah, so the dividend, like as I thought, would be a large portion of it. We don't know that this is the investment thesis, but ChatGPT AI is logically saying it's this: generates substantial free cash flow, money returns to shareholders via dividends and buybacks. Yes, so we've seen that as well. Share count has dropped. Dividend is around 5% currently. Recurring cash income for Berkshire's portfolio, which is attractive for a long-term holder. Yeah, I can see that. Another part of the investment case is dominant position in satellite radio, operates the only FCC licensed satellite radio network in the United States. Now that is a big deal. Effectively a monopoly in that niche that gives its pricing power, predictable subscriber churn rates, strategic operational improvements. Some commentary suggest Berkshire sees value in SiriusXM's potential to stabilize and improve its business cost cutting, which we've already seen. I pointed that out earlier. SG&A margin, let's come down. So we are seeing cost cutting. With the company now fully independent after a split from Liberty Media, its capital structure and strategic flexibility are clearer. Increases stakes steadily, roughly 35% of the company, often through subsidiaries and pension arms, not just direct BRK stock purchases. So, okay, so it's wasn't not all been Buffett as well. Low valuation multiples, which yes, on market cap it is, but on EV it isn't. So they're obviously thinking that they're going to pay down the debt. High dividend yield, steady cash flow, appealing to a long-term income investor, monopoly-like position, potential for operational improvement. All of these things are true, aren't they? We've pointed them out before reading this. Other than valuation multiples, on a market cap, yes, on EV, no. But if you're paying down the debt, then that changes things. High dividend yield, steady cash flow, monopoly-like position, satellite radio, operational improvements. Okay, yeah, I can see it, but I can't. I can see it, but I can't give a price, you know? Without paying down that debt. I suppose if you paid down like half the debt, what could you do? You could go to maybe a 10x. What was it historically? Never been. Oh, it was back here. What was the debt like back here? Have I got? I don't know what I need to do. I need to freeze paint this when we go sideways. How do I do that? There. View. Freeze paint. Oh, first column. I don't want first column froze. That is not what I wanted. Fuck up now, aren't I? Right. Cash minus debt there, so we'll just see the debt was significantly lower back then, which it was significantly lower. And it was trading at 10, 15 times. Okay. Pay down the debt, you might pay 10 times free cash flow. So which is what? Okay, 30. Okay, yeah. Now I'm starting to see something. 50% upside. Yeah, okay. Significant historical level in and around this area as well, look. A lot of price action in and out of this area. Boom, up, Okay. Yeah, I'm starting to see something. Maybe there. Yeah. Alright. Okay, I guess I can see the thesis. Am I comfortable enough with it? No. I'd say not, but I'm definitely going to put it on the watch list. If it gets cheaper, then yeah, I would definitely be interested in it. How cheap it could get, I don't know. If it would get any cheaper at all. But no, that makes sense, doesn't it? Outstanding shares are going down. Revenues are reasonably consistent. Cost cutting going on. Probably an ability to pay down debt. Reasonably consistent free cash flow. Lowish multiples, but debt's very high. If you paid down the debt, you'd obviously pay a higher multiple if you paid down the debt. So yeah, I can see it. I'm not sure. I'm not really going to do any discounted cash flow analysis on it, but I can see it. 5% dividend yield if you're putting in as much money as they are. You know, several million back a year. Yeah, interesting. All right. Put it in the blue and we'll move on. What's this one here then? I missed out on diamonds. Something to do with diamonds. Production and exploration of diamond properties operates through the Caro mine and where's that going to be? Oh, Canada. Doesn't look great though, does it? Have we got a balance sheet for it? LUCRF. Oh, spelled that wrong. SEC. Sex. SEC. LUCRF. Anything? Nothing. Okay, well, probably going to move on from that then. Not going to hang around on stuff that's got nothing there. I'm not interested in this. I did see this one actually. China. Not that I think there's anything wrong in investing in China, but I don't know that on companies this small that my data is going to be accurate enough to really dig into the weeds of things. Pardon me. Multi-channel gaming operations operates through the following business segments. Mecca and Grosvenor, so what's that? Casinos. It's going to be in the UK then, surely. Instead of the F, is there a UK version of it? No, maybe not then. I would have thought so. RNK there. Same thing, I'd imagine. Yeah. Mecca, Grosvenor. Had quite a fall from grace. Is this in here? Shit out of luck, aren't we? Short of pulling up the bloody going on the investor relations part of the page. I wonder what caused that. 140%, wow. Ooh. We are now trading. Shut this a minute. We are now trading, close to trading along a decent historical low. How back does that go? It's the lowest it's ever been. So we are close to all-time lows. Interesting. Maybe we will rank group. can't spell, but I still got a bloody microphone in front of my keyboard, so I can't really see what I'm writing. Where can we find the stuff? Financial performance, latest reports. Interim reports, here we go. Presentation, announcements. Is that what we want? Presentation. I just want to find a balance sheet. Here we go. 400 million in intangible. Well, half of it's bloody intangible. Keen on that generally. 140 million in property. 129 right of use assets. So they lease quite a bit. Probably just going to sack this one off. Is there... What's this? %. Is that true though? There's no... Profit after tax operations. 18.5. What's the market cap on it? Oh, that seems a bit steep, doesn't it? I mean, there's not really a lot of data, is there? There's not a lot of bloody FX clubs. What's FX and LFL? Underlying operating profit 40.6. Underlying net financing charge. Underlying profit before tax. Separately disclosed items. Restated. Where's the restated? There's basically zero. Lease liabilities. Only 25 million in long-term debt. I don't know. I can't see that. Grosvenor here, Mecca. Is there value? Is there a lot of value in those names? I don't know, really. Probably Grosvenor. Yeah, I would think so. Grosvenor's quite a. But Mecca Bingo and all that. I don't think anybody would miss Mecca Bingo being gone from the high street. And moving on from that one, we've done SIRI. Andrew Peller. What the hell's Andrew Peller? Alcohol. Problem is, I don't know if you can. These ones here, I'm guessing it's not the primary listing. The US is not the primary listing. I don't know if there's a thing to, choose primary listing. I don't know. SSL, Sasol. We got a chemical and energy company. Oh, look at this. Yawning, I don't know if you can hear that, but getting tired now. 100% upside since halfway through last year. Interesting, and historically been way higher. Alright, what's that? SSL. That's gotta be on here. Here we go. 20F. That's the last financial position. Oh, South Africa. Is that right? Yeah, South Africa. Have a look. Goodwill and intangibles, not high. Probably plant equipment, 158. I don't even know what their currency is, actually. Problem is, if the currency's dog shit, got to massively take that into account. Maybe I'll just stick to based in the USA for now. Where is total liabilities? Current liabilities 130. No, non-current. Sorry. So it's about 200. Total assets 359. It's about 160 in assets. Long-term debt 88. Cash equivalents there 40. What's the cash flows doing? 12 months. Where are we at? Cash available from operating activities 38. Cash retained from operating activities, so they paid out a little bit of dividends. Additions to property, plant and equipment. Cash used in investing activities is basically the same. So what's that going to leave you with? 13 for free cash flow. Do we have shares outstanding? 6. Oh god. That is very thin. 13 divided by bloody 643 million. Right, moving on. High peak energy, independent oil, natural and gas, acquisition, development and production. Okay, companies. Howard County, Fort Worth, Texas. Oh, I keep opening it, that's why. SHPK. SEC, HBK, interactive data. Straight up to the balance sheet. Got 165 million in cash. Proved properties, unproved. Total assets 3 billion. Long-term debt of 1 billion. Did an oil company the other day in Pitow. Depends what the level of the oil is as well, because Pitow was quite heavy crude, I think. It was not good oil for operating activities there. 418 million in operating activities, investing activities there, additions to crude oil, natural gas, properties, additions, acquisitions, proceeds. Okay. I mean, this is really in the fucking gutter. See if I can bring up my detail. How about lights? Do you know what? It'd be much easier to do this. Nothing's on it. That doesn't make sense. Did a whole bloody video on it. I even purchased it, I gotta be honest. I didn't write up about it. That doesn't make sense. I definitely did. Wrote up somewhere about it. BW. Maybe I did beat out on Grok. Alright, anyway. Let's drag it in. Who was it? HBK. HBK. Drag it in and see why it's in the fucking gutter. We definitely did write up P-Dow because I remember going through it on the screen. Where it's gone, I don't know. Still haven't found a better way of doing this. You're just going to have to get used to the copying and pasting. As unprofessional as it is, especially compared to what Roaring Kitty's spreadsheet was like. This is what you're stuck with, I'm afraid. $13 a share. Revenues have shrunk. Well, they have shrunk compared to last year. Interest expense, 119. Oh, there you go. This is why, straight up, big problem, huge red flag. 32 cents in simple free cash flow. Interest expense per share, 119. Interest coverage ratio, 0.27. There we go, straight out, not interested at all. Zero chance of. I mean, they could be in some serious trouble then, couldn't they? Debt? Any debt? Where's the debt? Gotta be on here somewhere. Long-term debt. 2028. 2028. Okay, so it's not due till 2028, but where's the operations there? Interest expense, 37 million. That's a killer, isn't it? Income from operations. Interest expense. Where's the... Is this simple free cash flow? Yeah. Warrants. Well, we've basically already said no. Interest coverage ratio of that. It's like, oh, no, thank you. What have they got the long-term debts on here? Oh, 0. That's not right. That is not right. Where? This is why sometimes you've got to check the data. Current portion long-term debt, 30 million. Long-term debt there. 1,162,300,000. There, it's not in there, look. 1,162,300,000, was it? Is that right? I think that's right. The total debt's wrong down here. Is that right? Let's just check. 1,162,300,000. do this. Look, equals plus 1162 300 123. There we go. Now serious, pardon me, they're in serious trouble. Interest expense is too high. Simple free cash flow is too low. Bruce Greenwald calculation from his net present value book. What's that book called? Can't remember, but quite interesting how Bruce Greenwald works out free cash flow. So that's what I've done there. I got effectively Michael Burry's simple free cash flow, CFO minus maintenance capex, and this one here where Bruce Greenwald actually has a calculation where you can split maintenance capex and growth capex here and here. Greenwald's coming back with his simple free cash flow significantly negative. I would say there is serious risk of bankruptcy here. I could be wrong. The assets are obviously worth quite a bit. They've got proved oil fields of like 4 billion. Long-term debt's only 1 billion. So no, maybe they're not a serious risk, bankruptcy, but certainly issues. What cool is this? 2020, there we go. The rebound from COVID, I would imagine. HPK. Right, anyway, I'm getting a bit tired, so I'm gonna hang up the phone here. Maybe we'll dig into HPK next time. What I will do off screen is I'll write up SiriusXM, because there's definitely a thesis there, especially if you've got a lot of money in it, but is it something that I'd be interested in? I don't know. There's quite a few people that are. You 8%, 7%, something like that. Funds, like position of their portfolio, percentage of their portfolio in it. Yeah, I'll write that up for sure. What we've come up with for a thesis for it, but I don't think it's something I'm going to jump into myself. Maybe we'll do a bit of digging on this one in the next video. Because if I don't get some sleep in a couple of hours, I'm going to be up changing nappies. So then I will not be very grumpy the next day. Right. All right. I will see you on the next one. We'll probably jump into HPK next time. All right. Thank you very much. And honestly, I think this video has not been good content. A lot of waffling, but it is what it is. See you on the next one.